Pleasure you could stay on. I am Pius Kujo Baka to our very first story. Inflation fell marginally to 53.6% in January 2023 from 54.1% recorded in December 2022. That's according to latest data from the Ghana Statistical Service. Now, according to the figures, the rising food prices pushed the consumer price index up. However, the transport inflation fell for the first time in 19 months due to the reduction in fuel prices during the period. Here is government statistician Professor Samuel Kopneni.
Generally, price levels of goods and services have gone up by 53.6 relative to January 2022. Comparing this to the rate that we recorded in the month of December 2022, rate of inflation stood at 54.1%, indicating a decline of 0.5 percentage points year-on-year inflation for December 2022 relative to January 2023. This is the first time that in 19 months, the continuous upward increase in prices of goods and services has seen a reversal with a decline of 0.5 percentage points. On a month-on-month basis, that is between December 2022 and January 2023, prices of goods and services went up by 1.7%. This is because CPI for the month of January 2023 stood at 165.6 relative to December 2022, 162.8. So prices of goods and services between December 2022 and January 2023 went up by 1.7%. Disaggregating this at the two major levels, that is between food and non-food inflation and between locally produced items and imported items, we saw a variation of 61.0% for food inflation relative to non-food inflation 47.9%.
Now, ratings agency Fitch Solutions has downgraded Ghana's creditworthiness to further junk status. In its latest report on Ghana, it said Fitch Ratings downgraded Ghana's long-term local currency issuer default rating to restricted default from C. Now, it attributed the downgrade to the decision by government to embark on the debt exchange program and the recent default on local bonds that matured on February 6th. Now, another one which is due for the payment this week. Fitch also affirmed Ghana's long-term foreign currency IDR at C, saying Fitch typically does not assign rating outlooks to sovereigns with ratings of CCCC+ or below. Let's now get on to Zoom and engage the thoughts of economist Courage Buti, who joins us via Zoom. Grateful Courage, you could join us on the marketplace. Now, let's first talk about the rate of the reduction. And from 54.1% to 53.6%. How significant is this rate, you would say?
Well, the magnitude, not so significant, but at least the direction shows that the December period, where we saw very sharp appreciation of the cedi and which triggered repricing of general goods and services on the market, ex-pump petroleum prices, we've seen it decline from almost 16 cedis to about 12.5 at some point. Some OMCs even quoted about 11 cedi upwards, really. And the impact on transport fares, where you saw some marginal adjustment in transport fares along the way, I believe all of those might have fed into the inflation print for the month January. That is why we are seeing that marginal decline. It backs off the trend from 18 consecutive months of increases, really. But doesn't mean inflation is at a peak. Not necessarily, because we have seen also the re-emergence of new price pressures going forward. VAT has been introduced, which would have price effect. We've seen fuel prices go up from the 12 cedi 50 pesos levels thereafter, and a number of other developments between that time and now, including utility tariff reviews that suggest that we could have probably some pressures to inflation even for the month February and March. So we are close to a peak. It appears we are near a point of inflection, and they can see that in the month-on-month print, which also slowed down significantly to about 1.7% for the period January. But then we are not exactly out of the woods. Maybe the increases from here on will be marginal, not the large ones we've seen before. But I don't think we have reached a peak yet. Maybe we'll observe data for the next 2-3 windows to get to that conclusion.
Courage, if you take a careful look at the data provided by the Ghana Statistical Service, you realize that non-food inflation contributed to the marginal fall in the January 2023 figure. And if we are to see the trend, this trend continues, how will the outlook of inflation be playing out?
Well, yes, so non-food, and you can interpret that mostly for the goods we do not produce locally. Most of the things we import that have imported inflation component even on them, and the exchange rate effect naturally will be affected by the repricing that happened, as opposed to the food items, most of which are from the local market, really, our local staples and some of the things we consume that are produced locally. And so the exchange rate dynamics will play a role. For January till now, you might say that all of these things happening on the positive side happened within the January pricing window, which just included 1 week of January, really. But I think in January itself, we saw the CD fall quite sharply again. It might have corrected a bit in February, and we've seen it a bit stable now, but it is still new sensitive. And so the February print, which will include most of February and the first week in March, would actually most of January and the first week in February would actually reflect the depreciation effects that we've seen for that period. And so the up and down movement may likely be there maybe in the next 2-3 prints before we could ultimately see inflation peaking. So yes, the non-food side of things will respond as things are now to the movement of the exchange rate and then the price development of the market.
I want to find out this from you. What steps or interventions must be taken to maintain a downward trajectory in the coming months?
Well, I think the refreshing thing will be that once the IMF program starts, we could have zero deficit financing going forward, which is imperative if we have to halt the demand side of the equation. The food solution or the food problem will not be solved in a day. And it's not about production per se, but it's about the distribution and the cost of imports, really, which are not exactly changing at the flip of the finger or stuff like that. So it would have to be gradual. Maybe going forward, once the disinflation process kicks in properly, you will see base effects start to pull it down. We have made progress with DDEP, so then it suggests that an IMF program might be in place anytime soon, which the balance of payment backstop that comes with it might be able to keep the CD a bit more stable going forward. I think the world has found a way of living with Russia, Ukraine, and so fuel prices might not be so pressured that much. And so I guess the natural forces would align ultimately, and we can see a steady path of decline in inflation. But in terms of interventions from our side, if we control the monetary side of things and to ensure that we control money supply, and then the interventions going into sectors like the agri and other productive sectors, those focusing on domestic industrialization and stuff like that, if we keep those ones up, then we can be solving the structural problems and ultimately returning inflation to a stable path of decline, but medium to long term in nature.
All right, let's switch topic now to the domestic debt exchange program. And on the back of that, the international ratings agency Fitch Solutions has downgraded Ghana's creditworthiness to further junk status. Now, in its latest report, it attributed the downgrade to the exchange rate, the debt exchange program, I should say. And what's your take on this update from Fitch?
It is to be expected, right? It is to be expected because maturities fell due that were not honored. And of course, government may have indicated that it's part of the debt exchange and all of that. But the debt exchange in itself is the reason they are doing this. Now that we've completed a debt exchange and people are getting less than what the initial terms of the bonds were, those are technically default issues. And per the metrics Fitch is using, it is to be expected that these decisions will come out. But it looks like it's not a doomsday thing. If the IMF program starts, if government is able, post DDEP, demonstrate that over the long term or demonstrate over their projections and then behaviors and actual fiscal performance, and the outlook suggests that we could be honoring those debts, even in these new forms as they are. And it will not be facing some of the similar issues we faced that led us to that some of these conversations. You can always get your ratings back, but on the basis of the fact that people are getting much less than what the initial terms of their bonds are. And especially, of course, this rating focused on just local currency debt, but similar thing was done when we suspended interest payment for external debts, really. I mean, it just tells you that we are giving the investors less than what they expected. And so those are, if you like, default situations, and that is why we are seeing the kind of ratings we are seeing. But post restructuring, if we can correct our books, if we can show some track record of being disciplined and be current on our obligations going forward, and these issues will not come up again, then of course we could get back our ratings, and rightly so.
Indeed, courage. But there seems to be a lot of concerns about how 35% of bondholders signed onto the program within a 24-hour duration to reach a final participation rate of 85%, and how the value of the exchange program basically is now 96 billion cedis from the original 137 billion cedis, as earlier communicated by the Finance Ministry. Has that occurred to you as well? Have you been wondering why so?
Well, I'll look at the numbers, and it is quite a surprise. Of course, the denominator is the issue here, and I've heard the theories about machinations, massaging of numbers, and all of that. I think what governments seem to be saying is that they have taken out some non-marketable debts. They have allowed some contractor payments who were given bonds in exchange for the obligations government owes them. They have allowed them now to swap some of those bonds for T-bills. I know those things existed. I know between 2021 and 2022, it happened the most, where some contractors were offered volumes of bonds. Those were the usual deposits you see on the bonds. I mean, it says exchange for payment, really. And it makes sense that if you are paying me my debt, considering everything you owe me and all of that, and you gave me bond in return, it is not fair for you to give me haircuts on those bonds at this point when they are services I have delivered and not pure investment I decided to make by myself. So on that score, it makes sense. But then the argument becomes, at what point did government realize that we need to exempt these people?
Exactly.
I mean, the first memorandum gave us 137 billion as the eligible bonds. It came down to 130 billion. In fact, that's at 7th February, when we were given 3 more days of administrative window. We were working with the 130 billion target, really. And so at what point did they change to 97? It leaves a lot of room for people's interpretations, and it questions the credibility of the numbers, really. But I think one thing holds true, which I have been trumpeting all this while. I do not think the 80% target was set by the IMF. We were supposed to do debt restructuring, and then we chose to start with a domestic debt restructuring. And have always maintained that we do not have to get the 80% to go to the board. And everything happening now suggests that if we were holding out for that 80% and assuming the IMF was aware of the 130 billion figure and working 80% of that, then obviously what we have gotten now would have worked up to just about 65%, which will mean that we could not engage the board for progress of the ECF program, really. So I do think that we needed to show some sign that we are burden sharing as locals, and then we can extend same to foreigners in terms of external debt restructuring. And to that extent, for me, so the fact that we have gotten about 82 billion people swapping their bonds for new ones is enough success, and we could build on that to go forward. But the credibility questions are very valid, and the way government went about handling it, I don't think was the best. And that is why these questions will linger on.
Talking about the credibility, about the numbers, basically, don't you think, or shouldn't the Finance Ministry come out and give a better breakdown of the figures in calculating the
it is in order if they are minded to give more clarity, because this kind of distrust, public distrust for policies and programs, especially coming from the Treasury, who control our finances and manage economic policy, is not good. You need to carry people along to make policy successful. And so to the extent there is always distrust about the credibility of the figures and all of that, it's not good for even policy formulation. And that is why I think it would be proper if we can get maybe better breakdown of what classes of people were invested, except that I know there are individual contractors who were paid monies using bonds. And if they are being excluded this time round, I think it's actually a fair argument. But my question is, why did it become an afterthought? Why is it coming very late in the day? Why wasn't it communicated at any point of the offer? That is where the issues are for me.
Earlier today, the Minister of Finance reassured pensioners picketing at his ministry. But before we take your opinion on that, let's take a listen or take a view of this issue I'm talking about, the Finance Minister.
Released a couple days ago, and I thought I had made it unequivocally clear that, all government bonds will be honored. And that, therefore, whether you are voluntary or not, whether you have tendered or not, it will be respected. So I really want to understand why we are still here, so that if there's anything more I can say, I can do that. But really, if you look at the press statement, it emphasized the fact that this was voluntary, and about 15–16% of the pensioners actually tendered. But they chose to. The bulk of you did not. But I had indicated that it was voluntary, which means that we will honor those payments. What I tried to do in giving you the option was that about almost 80% of you have bonds that go beyond 5 years, from 5 years going.
Finance Minister, how assuring is this reassurance to the pensioners?
Well, I think beside the credibility issue we are talking about, I think the point he's making is actually very clear from the word go. And I'm on record to have said that I do not exactly understand the demands of the individual pensioners, bondholders who are pensioners at this point, because it's still very voluntary, and the assurances, I think, are clear enough. And I maintain that it's actually not in government interest to actually default or not honor interest payment or even principal payment of these bonds, especially when you are an IMF program. IMF seeks to maintain and preserve the sanctity of the capital market and ensure free capital flow and all of that. And to the extent that they will be monitoring you for the next few years, you cannot even afford to default on those debts, really. Okay. And the support you are seeking from the Paris Club and other bilateral creditors are all hinged on your ability to be current on your obligation to investors, really. Right. And so I do not think it's even in government's own interest to default. But the reason probably these guys want it in test and explicitly stated like it's done for the pension funds is that they do not trust that it could be. And we've seen examples where things have been said, categorical statement, and they turn out that we renege with them or stuff like that. And so I guess it's still the credibility issue at play here. Sure. Otherwise, I think this is the clearest assurance yet that they are free to exempt themselves.
Thank you very much, Research Lead at GCB Capital, Courage Buti, with your expertise there. Now, let's touch on one story which, of course, will be of great interest to you. Expect prices of petrol and diesel to go down between 7 and 11% from tomorrow, February 16. That's according to the Institute for Energy Security. However, the price of liquefied petroleum gas will go up. We have Nana Amwisi VII, the Executive Director of the Institute for Energy Security, join us via Zoom for more on this. Nana, grateful you could join us on the marketplace. Now, how did you arrive at this expected fall in prices of petrol and diesel?
Good afternoon to you and to your viewers. What the IES does in trying to project or estimate what fuel price will behave like is they're looking at happenings on the international market as well as the domestic foreign exchange market in particular. Over the last 2 weeks, IES review of the international market found that price of gasoline that we call petrol here has dipped by 1.16%. Also, the price of gas oil has dropped by almost 13% on that market. What also bodes well for consumers of this product is that on the domestic market, the cedi appreciated by close to 1% against the important currency, the dollar. And so looking at these fundamentals, you can conclude that prices on the domestic markets will drop. And by our gauging, we foresee the price of both diesel and petrol dropping between the range of 7% and 10% going into the next 14 days.
Should consumers be hopeful of a further decrease going forward, considering that the cedi is showing some stability and the price of crude oil on the world market has remained relatively stable or low?
Should the cedi behave much stronger against the US dollar, it will be good for consumers, in that we also find that international price in the next 1 month will keep on dropping because the anticipated winter in Europe was not as harsh as we anticipated. So there is a lot of diesel stock available, and that is good for consumers. Also, the US refiners have almost finished configuring their plants to start the new petrol or gasoline production. And so if production from US in terms of petrol increases, it means that there will be much supply of both diesel and petrol on the international markets. And more supply means that prices of the products could be maintained or drop going forward. Unfortunately, we can't say same for liquefied petroleum gas going forward.
Why so? Why is it so? Because anytime fuel keeps dropping, we see the price of gas going up. Why so?
Yes, it does happen so because prices of LPG on the international markets have been rising steadily. Though the liquid fuels have been dropping, supply of gas have been quite challenging. That's natural gas, and you get a lot of LPG from natural gas, even though you get some LPG from crude oil. And so on the international markets, LPG price is higher. That is what will impact on consumers. But it depends on the margin of increase going into the next 2 weeks.
All right.
There could be an increase of LPG price on the international market, but if the cedi behaves well and stronger, it could, cancel out those effects.
All right. Thank you very much, Nana Amwesi the the Executive Director of the Institute for Energy Security, speaking to us there. You're still watching The Marketplace. Time to talk tech with Marketplace pundit and lead for iSolve Africa, Henry Kobler, has the updates us on what is happening in that area. Henry, grateful you could join us on The Marketplace. 5 years ago, Ghana launched its digital address system. That's the Ghana Post GPS. Would you say this has been a success?
Thank you very much. So it's a good plan. I mean, looking at the Ghana Post GPS and its prospects so far and how it's already been integrated and launched and also being on our doorsteps. But I think that when you get to technology, usually you're measuring the performances in years. And so if you're looking at a year in the tech field, that's a lot of adjustment and also to the law of upgrades. I mean, I think that looking at the application, it's a good way to have our addressing system come into play. But would we say that this addressing system is getting us the solutions that we want? I mean, as simple solutions as how can I have this addressing system in logistics sector where people that are using softwares in the logistics sector are benefiting from the application? Would we say that bankers are benefiting from this? I mean, relatively, we might not necessarily say so because there's no opportunity to integrate with the application, even though the application is a great prospect. But I mean, for me, I think that there's more to do in terms of how it's getting the impact to Ghanaians.
Now, Ghana's financial inclusion increased from 22% in 2011 to 68% in 2021. That's according to the governor of the Bank of Ghana, Dr. Ernest Addison. And he released that data that major factors promoting financial inclusion over the past decade were mobile money, digital banking, and of course, promotion of fintech solutions, which have gained widespread popularity. Now, even in these areas or interlands, are we on track with the digitalization agenda?
Yes, I would say we are on track. I mean, generally, if you're looking at the numbers, there's always a growth. With mobile money and mobile payment systems or electronic payment systems, I think that the growth with the fear of the e-levy was going to stifle the growth. But I think that that fear has sort of been overrated, and there are quite a number of transactions still going through on online platforms. I think that the prospects for the future are high. But what we could definitely be looking at as a country is developing this infrastructure, because, I mean, all over Africa, there are transactions that are going huge in and out. And so whilst we're leaving these jobs to fintechs, I think that the Bank of Ghana is also doing some great work in terms of bringing up solutions so that regulatory-wise we can sort of be on the right path and have people that are using these services be safer on there. One of the things I can think of in considering in terms of infrastructure improvement is security. I mean, quite a lot of effort is sort of happening, but you don't have that quick solutions in making sure that whenever people are being frauded on some of these applications, they have a quick solution in retrieving their funding. And I think that's one of the problems in there.
Thank you very much, Henry Kabla, for your time here on The Marketplace. And that's it for The Marketplace. I am Pius Kujubaka. You can get stories when you log on to myjoyonline.com/business. Do enjoy the rest of our programs. Bye-bye.